Hi, my name's Martin O'Neill. I teach political philosophy in the Department of Philosophy at the University of York. And this is one of a series of talks that we have looking at different philosophical issues related to the COVID pandemic. Now, one thing that that one might worry about in terms of the social effects of the pandemic are the way in which it could lead to a kind of increase or an acceleration in existing trends in inequality, which raises issues, I suppose, of two different kinds. So on the one hand, there's a question about what we should think about that, normatively speaking. Do we think it's problematic if society becomes more unequal in certain ways? So that's one set of issues. And then another set of issues are a set of issues about what we think ought to be done about that. What would a justified policy response be? What sorts of things should a government do, or should other agencies do in order to try to deal with that problem of increased inequality, if we do think it is a problem? So what I want to do today really is just to present some ideas from an article that was published yesterday in the Guardian newspaper, which I wrote along with my co-author Joe Guinan, and it extends some of the ideas that we'd worked through in this book that came out last year in 2019 on the case for community wealth building. So in our Guardian piece yesterday, Joe and I argued that the kind of inequality that's generated by COVID is going to require concerted state action in order to make sure that its implications in the years ahead aren't going to be of a kind to create social problems and economic problems that would really be unbearable to live with. Okay, so here's what we said in the article. So the economy before the pandemic has disappeared. Rather than simply returning to things how they were before the coronavirus shock, we're set to emerge into a shattered economic landscape. Huge numbers of jobs have been lost already, and countless small businesses are laden with debt, now teetering on the verge of bankruptcy. In the absence of additional government assistance, many of these businesses may well disappear forever, further gutting our high streets and hollowing out our local economies. So for better or worse, the pandemic is going to create a new version of economic normality with new patterns of economic ownership. And one of the clear dangers that we'll face in the aftermath of COVID-19 is therefore increased inequality. Many small and medium enterprises, SMEs, are likely to go bankrupt, allowing further consolidation by the largest firms. Private equity sharks waiting in the wings then will be likely to snap up distressed business assets for pennies on the pound. Quite a common feature that in times of crisis, it's those who are already relatively well off who are able to weather those shocks and who often actually benefit from the effects of crisis. Now, the Bank of England's response to this has been the same response it's had to the last crisis, to turn on the money taps of quantitative easing, i.e. to create new money in order to buy up assets and to support asset prices within the economy. The theory of that being that then has trickle-down effects, that has kind of general effects to prop up economic activity. But what Joe Guinan and I argue is that kind of unfocused approach to supporting the economy, which drives up asset prices, just has the effect primarily of making the rich even richer. But it does very little to increase spending or support for the everyday economy of small businesses that are actually essential for the recirculation of local wealth. So our economy after COVID-19 could well turn out to be merely an uglier, more distorted version of the kind of lopsided economic system that we already see today. We may have stumbled into what we've called an Amazon recovery, where big businesses and corporate behemoths hold an even greater share of the market, where billionaires get richer and more numerous, and where inequality in effect becomes supercharged. So like a handful of other corporate giants, Amazon, which I think is a very interesting example of a company that does well in the current crisis, has seen its business expand during the COVID epidemic. In the US, the company's taken on 100,000 new workers between mid-March and mid-April, and is looking to create a further 75,000 posts. Its stock price has soared by more than 50% since the beginning of April. And Amazon's founder, Jeff Bezos, now the richest man in the world, the richest person in the world, perhaps the richest person that there's ever been, has seen his wealth increase by over $30 billion, about £24 billion during the pandemic. The global billionaire class then has never had it so good. So, if the government wants to ensure that the recovery works for everyone, and not just for the richest, what should it do? Well, a large part of the answer, we argue, should lie in a move to block that kind of corporate consolidation and predatory acquisition, preventing what one might think of as the leverage buyout of the real economy. That could, and this is our kind of novel proposal, take the form of a state holding company with a mandate to support struggling SMEs directly through the coronavirus era and to prevent the destruction of what remains of the UK's already much diminished local small business sector. That structure could then target businesses that were cash positive before March and which can be once again once the crisis has passed. And later, where appropriate, that holding company could relaunch many of those rescued businesses under conditions of worker ownership or community ownership, or as mission-driven social enterprises. In that way, a state holding company could become an important instrument in the green transition, building community wealth by supporting local economic activity. Now, that's one mechanism that we think ought to be considered and discussed. But what's the reason, really, for doing that? What's the reason for caring about a situation whereby there could be that kind of greater consolidation of corporate power and of wealth within the economy? Well, the fundamental reasons, I think, and this, I guess, is where the distinctively philosophical part of our argument comes in, connects to the values of democracy and equality. So a democratic society can't really flourish under conditions of unrestrained inequality, and will be even more imperiled in an economy where wealth and power get further and further concentrated. The only alternative to an unjust recovery, then, we think, is to use state power to protect smaller firms and to create a more democratic economy where ownership and economic rewards are more broadly shared. The reason for doing that, it's not just because we think there's an unfairness if economic rewards are kept by the billionaire class, but when both economic power and political power and the ability to kind of set the agenda for economic life become concentrated among just a small section of the overall population, that doesn't seem like the kind of conditions under which you can have the kind of society that you might aspire to insofar as you think about your society as a democratic one. Now, one thing that we think is very important is that historical examples are very useful here. History is a useful guide. So the kind of structure, the kind of state holding company that we're advocating here is very similar to a move that lay in the heart of the US response to the economic crisis of the 1930s. Under Franklin D. Roosevelt, the Reconstruction Finance Corporation, a state holding company, was permitted to acquire failing businesses until they could be relaunched during the recovery away from the Great Depression. But as one of the engines of the New Deal, the RFC, the Reconstruction Finance Corporation, became not only the biggest bank in the US, but also the single largest investor in the country. So what FDR did was, when appropriate, he used the power of the state in a very directed way in order to change the shape of the economy and to disperse economic power and economic rewards more broadly through the US economy. Public holding companies are also commonplace around the world. Examples range from Temasek Holdings in Singapore to the Ministry of Enterprise and Innovation in Sweden and the Agence de Participation des États in France, which oversees the French government's ownership stake in nearly 100 enterprises. Now, the current UK government has already embraced this principle as part of what it's called Project Birch, which is this government initiative to bail out large corporations deemed to be of strategic importance to the economy in return for taking equity stakes. But what we argue is that if such a move is permissible to rescue giant corporations, then why not also the small business sector? Nothing could be more short-sighted than rescuing airlines while ignoring local firms, including the very businesses that will be needed to create a more sustainable economy for the future. Nor can a balanced recovery be run by central diktat from Whitehall and from the Treasury. Public holding companies could instead be established at a number of different scales, including by the devolved governments of Wales, Scotland and Northern Ireland. So Boris Johnson, especially in the last week, has wrapped himself in the mantle of FDR. There's been a lot of rhetoric about the examples of that Roosevelt gives and about attaining some kind of New Deal. But Johnson's rhetoric, I'm afraid to say, is rather cheap. What I think democratic citizens need to do now is to hold him to account on the basis of what a genuine New Deal would actually require. Now that might sound ambitious, but ambitious action is really our only hope to avoid a future that's owned by the corporate behemoths, where there is that kind of concentration of power and economic reward that you see after a large crisis. If we're going to prevent the large-scale collapse of the SME sector, then history shows that we need massive government intervention. That really would be a New Deal. So whereas Mr. Johnson might talk the talk, our suggestion, our argument is that there's very good reason for the government to walk the walk on that. So the vast power of the state was used, as we've seen, to put the economy on life support during a really quite unprecedented economic shutdown. But now that same power should be used to ensure that the economic recovery doesn't only benefit a small elite, as has too often been the case with crises in the past. Instead of ushering in a grim new era of supercharged inequality, the recovery could be the opportune moment to build a better economy. But that will only happen if citizens demand it. So that's an argument about why an increase in inequality, both of economic returns and of economic power, would be a very bad outcome. And it's also an argument about how and why it might be appropriate for the power of the state to be used to block that kind of economic change. If you're interested in some of those lines of argument, then I'd of course recommend having a look at this book, available at a very good price from all good bookshops, The Case for Community Wealth Building by Joe Guinan and myself, Martin O'Neill, out from Polity Press, where we make some arguments about how, if you take seriously equality and democracy as normative values that ought to structure the organisation of the economy, how that should have some implications for how economic policy and economic development proceeds at different levels. So at the city level, the regional level, the subnational level, and so on, and what local government can do to create more equal and more democratic societies. So buy the book, and thanks very much for listening. Bye-bye.